output could rise sharply. Some estimates suggest production could climb by roughly 30% from current levels, potentially adding hundreds of thousands of barrels per day. Timelines remain uncertain, tied to infrastructure repairs, security conditions, and political follow-through. Still, if these reforms are implemented, they represent a genuine turning point, the possibility of restoring Venezuelan production at meaningful scale. And if that production does return, the consequences will not stay confined to one country. Venezuela's return sends shockwaves through global oil. The reemergence of Venezuelan crude is not just a U.S. Venezuela story. It is already rippling across global oil markets. Forecasts point to demand growth in 2026, yet supply continues to outpace consumption, keeping prices under pressure even amid geopolitical shocks. Reintegrating Venezuelan barrels helps rebalance the heavy crude market, influencing benchmarks like Brent and WTI. With OPEC Plus limiting output growth, every incremental barrel matters to traders and refiners alike. Beyond pricing, insurers, shipping companies, and risk models are being recalibrated as sanctions enforcement adds uncertainty to maritime trade. Strategically, Venezuela has shifted from being a China-leaning supplier to a contested asset, drawing interest from the United States, Europe, and India. This is less about volume alone and more about who controls access to one of the world's largest heavy oil reserves. Verdict: Venezuela's oil future. Revival, reroute, or relapse. The 2026 reshaping of Venezuela's oil sector stands out as one of the most consequential energy developments of the decade. After years of sanctions, underinvestment, and collapsing output, Venezuelan heavy crude is re-entering global markets through a complex mix of U.S. brokered exports, evolving licenses, and selective capital inflows. U.S. Gulf Coast refiners gain an immediate advantage, securing discounted barrels tailored to their most complex facilities, while China and India reassess supply strategies under new pricing and political realities. Inside Venezuela, reform efforts and the prospect of higher production, if stability endures, offer a path toward reviving one of the world's largest crude endowments. This isn't a clean reset. It's a global energy reroute with lasting implications for refinery margins, geopolitical alliances, and oil market dynamics. Now we want to hear from you. Does U.S. control stabilize Venezuelan oil flows, or does it simply politicize them further? Will Gulf Coast refiners maintain their edge over the long term? And can reforms truly revive production, or are the risks still too high? Share your thoughts in the comments. Before you go, subscribe to Piston Pundit so you don't miss our next deep dives and vehicle updates. Thanks for watching and see you next time. You can check out any of the videos on your screen. There's plenty more to explore. Welcome back to Piston Pundit, your ultimate pit stop. Oil may not ignite pistons on its own, but it fuels the massive industrial engine behind cars, factories, and entire economies. Few countries have influenced that system more profoundly than Venezuela, a nation sitting atop some of the world's largest proven crude reserves. For decades, U.S. Gulf Coast refineries were almost perfectly engineered for Venezuela's heavy, sulfur-rich oil. Then came early 2026 U.S. intervention. A sharp shift in export controls and rerouted trade lanes shattered long-held assumptions. Now U.S. refiners, Asian markets, Indian buyers, and Chinese players are all racing to adjust as crude flows, sanctions, and strategic rivalries collide. Why Venezuelan heavy crude became refinery gold. Venezuelan oil isn't just oil. It's a very specific mechanical problem. Its heavy, high-sulfur makeup makes it thick, dense, and difficult to refine, especially compared with the lighter shale grades flooding North America. But for advanced U.S. Gulf Coast refineries, that difficulty was the opportunity. These plants poured billions into delayed cokers, sulfur handling units, and hardened steel systems designed to break stubborn molecules into gasoline, diesel, jet fuel, and petrochemical feedstocks. Think of it like a high-compression engine tuned for a very particular fuel blend. The math was simple. Buy discounted heavy crude, apply elite refining hardware, and sell premium products. Venezuela supplied the feedstock. Refiners supplied the engineering. Chemistry made it work. Politics ultimately broke it. 2026 power shift. Control of Venezuela's oil changes hands. Refinery chemistry alone didn't collapse the system. Geopolitics did. At the start of 2026, Venezuela's oil equation shifted abruptly. U.S. intervention accelerated a power transition, removing Nicolas Maduro and placing effective control of oil exports under Washington's influence. This wasn't symbolic diplomacy. It was direct leverage over the country's primary revenue source. Almost immediately, U.S. regulators moved away from tightly controlled case-by-case licenses toward broader export authorizations. The objective was clear: reintroduce Venezuelan crude to global markets. Under the new rules, reports surfaced of multi-billion-dollar supply deals and ambitious long-term infrastructure investments. The message to the market was unmistakable. Venezuelan oil was no longer sidelined. It was being selectively reintegrated, reshaping who could buy it, how it was priced, and which refineries would gain first access. Gulf Coast refineries reclaim heavy crude advantage for U.S. Gulf Coast refiners, the shift felt like a long-awaited green light. Operators such as Valero and Phillips 66 moved quickly to lock in Venezuelan barrels through newly authorized channels, often at meaningful discounts to global benchmarks. These facilities were already built for heavy sour crude, so bringing Venezuelan oil back was like reinstalling a familiar component in a proven system. Analysts estimate tens of millions of barrels could re-enter global circulation, with hundreds of thousands of barrels per day flowing into U.S. plants. That scale matters. Heavy crude discounts boost margins, improve refinery economics, reduce reliance on imported high-sulfur fuel oil, and strengthen competitive positioning. Still, sanctions frameworks and licensing rules mean the restart isn't instant. This is a controlled ignition, not a full-throttle sprint. Before we dive deeper, do us a favor and smash that like and subscribe button. Helps us reach more auto enthusiasts just like you. Now, let's shift gears and steer toward the global reaction, because while U.S. refiners surged ahead, Asia didn't take the same route. Asia pulls back as Venezuelan oil flows west. Before 2026, a large share of Venezuelan crude moved east, especially to China, where state-owned refiners had spent years adapting their systems to handle heavy barrels. Under the new export framework, that current has slowed. Chinese majors reportedly pulled back from U.S. controlled Venezuelan cargoes, pointing to pricing terms, regulatory oversight, and contractual complexity. This wasn't a rejection of heavy crude itself, but a recalculation of risk versus reward. India has shown interest as its refiners expand heavy oil capacity, but U.S. prioritization and narrower pricing spreads have capped volumes. Across Asia, buyers are hedging by sourcing alternative heavy grades from the Middle East and beyond. The result isn't a simple east-to-west flip, but a fragmented rebalancing driven as much by politics as by refinery hardware. And when trade patterns shift, enforcement pressure